Picture this, a company worth over $50 billion, generating billions in profit every year, and yet the actual team running the operation could probably fit inside a single conference room. That company is Wheaton Precious Metals Corp, and by the end of this video, you'll understand why its numbers look almost too good to be true, and why one specific chart pattern right now has some investors scratching their heads. Let's start with size. Wheaton Precious Metals currently carries a market cap, meaning the total value of all its shares combined, of $50.72 billion. Its enterprise value, which is basically the market cap adjusted for cash and debt, sits slightly lower at $48.58 billion. Normally, enterprise value is higher than market cap because companies carry debt. Here, it's the opposite, and that's your first clue that something unusual is going on with this company's balance sheet. We'll come back to that. Now, here's where it gets interesting. With 454 million shares outstanding, ownership has barely moved, up just 0.11% in a year. But look at who owns those shares. Institutions hold 77.17% of the company. Insiders, meaning executives and directors, hold just 0.11%. That's a massive gap. It tells you this is a stock dominated by big funds and professional money managers, not by the people running day-to-day operations. At first glance, the valuation looks expensive. The trailing price-to-earnings ratio, or PE ratio, which tells you how much investors are paying for each dollar of past profit, sits at 28.17. That sounds high. But here's the twist. The forward PE, based on expected future earnings, drops to 21.47. That gap suggests the market is pricing in meaningful earnings growth ahead. And when you look at the forecast numbers, revenue growth over the next 3 years is projected at 23.43%, with earnings per share growth projected at 23.24%. So that expensive-looking PE might not be as expensive as it first appears. But here's where things get really interesting. This company has just 41 employees, 41, and yet it generated $66.97 million in revenue per employee and $43.9 million in profit per employee. Those are staggering numbers for any business. It suggests an extremely lean operating model where a small team oversees a very large financial engine, and that engine runs on remarkably high margins. Gross margin sits at 85.81%. Operating margin is 71.94%. Profit margin is 65.55%. To put that in perspective, most companies in the world would consider a 20% profit margin excellent. This company converts almost 2 out of every $3 in revenue straight into profit. Now let's talk about the balance sheet, because this is where the earlier mystery gets solved. The company holds $2.16 billion in cash against just $7.66 million in total debt. That's a net cash position of $2.16 billion, or $4.75 per share. Debt to equity sits at 0.00. Interest coverage, which measures how easily a company can pay interest on its debt, is 4,489 times. That number is almost absurd in a good way. It means debt is essentially a non-issue here. This is also reflected in the Altman Z-score, a formula used to estimate bankruptcy risk, which sits at 50.18. Anything above 3 is generally considered safe. 50 is extraordinarily high, but here's where investors often get confused. Despite all this strength, the stock is currently trading below both its 50-day moving average of $118.45 and its 200-day moving average of $124.12. Yet the average analyst price target sits at $171.45, which is 53.79% above the current price, with a consensus rating of strong buy from 16 analysts. So you have a stock trading below its recent trend lines, while the same data shows strong underlying profitability and financial health. That contrast alone is worth sitting with. One more layer worth mentioning is cash flow. Operating cash flow came in at $2.31 billion, but after capital expenditures of negative $1.31 billion, free cash flow drops to $1 billion. That's why the price to free cash flow ratio at 50.56 looks much higher than the price to operating cash flow ratio of 21.96. Heavy spending is clearly eating into the cash that's left over. On the dividend side, the yield is modest at 0.65%, but the payout ratio, meaning the percentage of profit paid out as dividends, is just 18.2%. Dividend growth year over year was 12.5%. A low payout ratio combined with double-digit dividend growth is often seen as a sign that a company has room to keep increasing its payout over time. So where does that leave us? On one hand, you have a company with almost no debt, extremely high margins, massive per-employee productivity, and a share price sitting well below analyst targets. On the other hand, you have a stock trading under its own moving averages, a free cash flow yield of just 1.98%, and a valuation that still requires real earnings growth to be justified. The numbers tell a story of strength and tension existing side by side. The real question is which side of that story plays out next.